Hey everyone, welcome back to Corporate Decoder, the place where we dig through the financial statements to find the real story behind the numbers. Today we're looking at Honeywell International Incorporated's latest filing, and let's just say there is a bit more going on than meets the eye. Honeywell International Incorporated, a name you probably know, has put out some important updates. This report, filed on the 17th of February 2026, is mainly about their annual report for the year ending the 31st of December 2025. But here is the juicy part they're highlighting. They've had to adjust their financial picture, particularly concerning some businesses they're looking to sell. Remember back in January when they announced their earnings and mentioned they were putting their productivity solutions and services, or PSS for short, and their warehouse and workflow solutions, or WWS for short, businesses up for sale. Well, it turns out those businesses are worth less than they thought. They've had to record some pretty significant impairment charges for these assets they plan to sell. Think of it like this when you try to sell something but realize it is not in as good a condition as you hoped, so you have to lower the price. Honeywell is doing that with these business units. So after they released those initial earnings, more information came in. This new information means they had to take even bigger hits on the value of these businesses they want to get rid of. It is like finding more damage on that item you are trying to sell after you already decided on a lower price. These extra charges are now reflected in their big annual report, the 10K. It means their reported profits for the year will be lower because of these write-downs. To explain the financial impact of these adjustments, Honeywell also released a press statement. This statement is attached to this filing as an exhibit, basically an extra document for us to look at. It is meant to clarify just how much these businesses that are up for sale are affecting Honeywell's overall financial health. Now, let's look at what Honeywell has publicly traded. They have their common stock listed on the Nasdaq, which is pretty standard. But what is interesting, and this is where we often see a lot of financial activity, are all their various notes. They have a whole list of senior notes, which are essentially loans they've taken from investors, maturing at different times. Here are some of the notes they have outstanding. They've got 3.500% senior notes due in 2027, and other notes maturing in 2028, 2030, 2032, 2034, and even 2036. This tells us Honeywell is a significant borrower using debt to fund its operations and growth. Each of these notes has an interest rate attached, and they're all due to be paid back at different times. The tickers for these notes like HON27, HON28A, HON30, HON32, HON32A, HON32A, HON34, and HON36 often give us a clue about the interest rate and when the debt matures. For example, HON27 likely refers to the 3.500% senior notes due in 2027. Seeing a company with so many different debt issuances suggests a complex financial structure, and it is important to keep an eye on their ability to manage all these obligations. And finally, the report is signed off by Su-Ping Liu, who holds the important title of Senior Vice President, General Counsel, and Corporate Secretary. This signifies that the company has officially reviewed and approved the contents of this filing. Alright, let's break down what this all means. Honeywell is in the process of selling off two of its business units. PSS and WWS, the bad news is that these businesses are proving to be worth less than anticipated, leading to significant financial write-downs. This is a common occurrence when a company decides to divest a segment it has held onto for a while. The market can sometimes tell you that a business unit is not as valuable as the company's accounting books might suggest. The fact that these impairment charges are substantial means that the market's perception of these businesses, or perhaps the market for selling such businesses, is quite tough right now. This could signal that the overall performance of these segments has been weaker than expected, or that the cost to transform them into saleable assets is higher than initially thought. Honeywell also has a substantial amount of debt, evidenced by the various senior notes they have outstanding maturing over the next decade. While having debt is not inherently bad, especially for a large corporation looking to finance growth, the scale and variety of these debt instruments warrant attention. Investors will want to be sure that Honeywell's core, continuing businesses are strong enough to service this debt, especially with the added drag from the underperforming divested segments. Looking at the bigger picture, Honeywell seems to be undergoing a strategic shift, aiming to streamline its operations by selling off businesses that might not fit its long-term vision or are not performing as well. This process of shedding assets can be a positive move if it allows the company to focus on its more profitable and growing areas. However, the significant impairment charges suggest that this selling process might be more costly and painful than initially hoped. We need to watch how Honeywell reinvests the proceeds from these sales, and whether its remaining businesses can truly accelerate growth and profitability. The key risks here revolve around the execution of the sale process, the potential for further write-downs, and the company's ability to generate sufficient cash flow from its core operations to manage its debt obligations and fund future initiatives. What is your take on Honeywell's situation? Do you think shedding these businesses is a smart move despite the impairment charges, or does it signal deeper issues? Let me know your thoughts in the comments below. If you found this deep dive into Honeywell's financials helpful, give this video a thumbs up and subscribe for more corporate breakdowns. And don't forget to join our Discord community linked in the description for more discussions. Thanks for watching, and I'll see you in the next one.